So I just got off the phone with a referral partner, a newly minted referral partner, and we were getting to know each other a little bit and going over the particulars of her business and my business. And one of the questions she asked was, "Well, what's a non-bank loan? What types of businesses, borrowers, and loans should I be referring to you?" So that's a great question because most people don't know what a non-bank loan is. Even people in the business have no idea what a true non-bank loan is, and especially as it's defined by Comcap. So a non-bank loan at its core, in essence, is any bank, or I'm sorry, any loan that a bank won't originate, right? But the reasons are many and varied and can depend upon whether it's a community bank or a regional bank or a national bank or whatever picadillos that particular bank may have in that particular lending vertical. And there are a ton of them. So, given the time constraints of the video of the vlog, we'll keep it to the top 10. So, the first one is unique property types. We just funded a loan for a borrower that owned 36 gas stations. Amazing borrower, incredibly successful company. Properties were amazing as far as the equity. Everything about these particular loans, about these deals, were gold. The only rub, the only challenge with those loans is that they were gas stations. So you'll find that most banks will not do a loan for a gas station. They just won't. If they will, it's most likely an SBA loan, which are great loans, but this particular borrower didn't like that the SBA on some products will place junior liens on your personal assets as well. That varies bank to bank too, as far as the overlays go, as far as the interpretations of the SOP in terms of the SBA can vary widely, but that's a topic for another time. So number one, any kind of unique property type. It doesn't matter how great the borrower is, how solid the credit, what the property is like, as long as it's a specialty unique property, that's an opportunity for a non-bank lender, non-bank broker to make a lasting impact with great rates, great products, and really provide wonderful execution across the board to the borrower. And unique property types can be hospitality, they can be fuel gas stations, they can be agricultural farms, even land, although that gets a little nichey with land. You have to be careful. That's number one. Number two, lower credit scores. Now, I think when people hear the word non-bank, they associate it with non-prime or subprime, and they go right to lower credit scores. Now, while it's true that we do have products that aren't FICO-driven, bridge products, for example, equipment loans, for the most part, are more concentrated or more concerned with the equipment and the repay than the credit. There's generally a program for borrowers with really low FICO scores for equipment and for bridge products, certainly too. But once again, that's a great example of a borrower going to their bank, and let's say you've got poor credit for reasons that make sense. They are most likely not going to walk you through the process of getting that 540 to a 620, even though it may be as simple as a couple of trade lines and pulling back in your credit utilization. They just won't offer that service. It's not within that bank model. So we've got unique property types. We've got lower credit scores. Now, on that lower credit score topic, I also have to mention most lenders, or most banks, I'm sorry, all banks really, have their own overlays to the SBA guidelines as it relates to credit, as it relates to documentation, as it relates to when and where they place junior liens. So if you present me with an SBA loan and I send that out to 10 banks, I'll get 10 different responses. Now, maybe, depending on the loan request, the responses, the differences among those banks that are vying for that business, the differences are relatively minimal. Some are sweeping. And to just leave the fate of your loan, of your business, of your livelihood in one bank's hands is incredibly short-sighted. Give us an opportunity to shop that loan, to go to national, regional, local community banks to find the best deal for you. That's our model at its core. So we've got unique property types, we've got lower credit scores. Bridge loans and private money are the third, I lump them together, the third type of non-bank loan product that we offer. You're not going to obviously get a private money loan at a bank. You're not really going to get crazy competitive bridge products at your bank. We've got folks that specialize that do nothing but perform bridge transactions. So the speed of the process, the documentation of the process, the nimbleness of that particular loan cannot be matched by your bank. Number 4, bank statement loans. There are still segments of the marketplace, in particular restaurants, bodegas, salons, that are heavily cash driven, and the true success of their business, the true revenues of their business can't always be traced to tax returns and financials, right? There has to be a bank statement product to help them get the financing they need and the pricing that they deserve based on their credit and their performance. You're just not going to get a bank statement opportunity at a bank. Now, that's number 4, and I'm just going to pause here for a minute to say we love our bank partners. The bank model works. The bank model is awesome. Banks make money. Shareholders are protected. Bank customers are protected. There's a branch on every corner. Everyone's happy with the bank model, except when you get turned down.